Markets just hit an iceberg and almost no one is sounding the alarm. It happened in the most trusted corner of global finance, and the shockwaves are starting to spread. This is not some abstract risk. Treasury bills, often called the safest asset in the world, are showing cracks. Yields are surging, auction demand is weakening, and liquidity is drying up. At the same time, institutional investors are quietly shifting their positions behind the scenes. If this trend continues, it could trigger a major disruption in the financial system. Let's start with what should have been a routine data point. As of June 26, the yield on the 3-month Treasury bill sits at around 4.39%. That might not sound alarming on its own, but is more than 2 full percentage points above inflation and far above historical averages. The concern is not just the rate itself, but the market behavior around it. In May, a 20-year Treasury auction raised only $16 billion and was considered a failure. Investor turnout was weak and yield spiked to over 5.12%. Then in June, a 30-year auction fared no better. Yield settled at 4.84%, barely improved from the previous spike. These are not isolated glitches. They are flashing red warnings. Behind the scenes, there's a more dangerous shift. Since January, the U.S. Treasury has slashed bill issuance by nearly $375 billion. The reason? The ongoing debt ceiling stalemate. As a result, the market is facing a supply shortage of Treasury bills, the very instruments that serve as foundational collateral in the global financial system. This shortage is more than a technical hiccup. Money market funds, pension plans, hedge funds, and even foreign central banks rely on a healthy T-bill market for day-to-day liquidity. When supply falls off a cliff, that entire structure begins to wobble. Last month, demand for non-competitive bids at auctions reached $15 billion. That is a significant spike. When safe assets become scarce, financial institutions either hoard what they have or rotate into more complex alternatives, both of which introduce new risks. Volatility is already increasing. Funds are under pressure. Spreads in the money market are no longer stable. These are not academic concerns. They are signs that a major liquidity problem is building in real time. The public narrative focuses on yields topping 4%, as if that is some kind of investor gift. But the real story is structural. Treasury bills are supposed to be the most liquid, most stable form of short-term collateral. If their market structure starts to fail, the financial system is exposed. This is why major players are making moves. Hedge funds, sovereign wealth funds, corporate treasuries, and central banks are shifting assets. Some are moving into ultra-short corporate paper. Others are buying derivatives or turning to longer-dated treasuries. The flows are fragmented, and that makes everything more fragile. When institutions begin acting defensively, liquidity thins out even faster, and there is a broader macro pressure. U.S. federal debt has ballooned to nearly 98% of GDP and is projected to hit 117% by 2034. Debt servicing alone could take up 4% of national GDP in the coming years. If yields stay high, the pressure gets worse. According to the Congressional Budget Office, interest payments could reach 30% of total federal revenue. That is unsustainable. The market is starting to show signs of stress, but the bigger question is what happens if confidence breaks? Or if the issue is no longer just yield but actual short-term liquidity? That fear has not shown up yet in the mainstream headlines, but if it does, the spiral will be fast. Right now, the Treasury and the Federal Reserve are out of sync. The Fed has floated the idea of rate cuts later this year. Meanwhile, the Treasury is slashing new bill issuance due to the debt ceiling conflict. If funding markets seize up, the Fed could be forced into action earlier than planned. The issue is not just political, it is functional. When governments stop issuing their safest form of debt, financial institutions are forced to improvise. The Treasury is currently covering cash needs without issuing new bills. That might work in the short term, but once those internal cash lines run out, they will need to flood the market with new supply. That sudden shock could trigger a cascade of unintended consequences. Local governments, regional banks, and even credit unions rely on T-bills to park funds securely. If the foundation becomes unstable, even temporarily, it can trigger margin calls, force selling, and liquidity spirals. These are the small cracks that come before a major break. And if T-bill instability spreads, the effects will not stay contained. Corporate supply chains, dollar-based funding markets, and even foreign exchange liquidity could come under pressure. The repo market could freeze. Bank reserves could drain. The last time something similar happened was during the financial crisis, and the pattern looks eerily familiar. This does not mean a collapse is certain, but it does mean the preconditions are forming. And the policy response so far has been reactive, not proactive. So what should you be watching? Start with spread indicators. If the gap between T-bills, repos, and Euro-dollar futures begins to widen sharply, that is a sign of hidden pressure. Next, monitor the bid-to-cover ratios at Treasury auctions. A ratio below 2 in short-term bills is a danger signal. It means the government is struggling to find buyers. Also, keep an eye on money market fund flows. If large amounts of capital are leaving government funds for cash or corporates, that is stealthy risk-off behavior from institutions that usually stay conservative. Watch for shifts in macro guidance. If the Fed suddenly pivots on interest rate policy, or if the Treasury announces massive new bill issuance, those are signs that internal stress is escalating. Current estimates suggest the Treasury may need to issue between $1.4 and $2 trillion in new bills through 2026. That wave of supply will only work if the market still trusts the product. If that trust weakens, yields will need to rise even more to attract demand. In this kind of environment, blind faith in the phrase safe as treasuries could be a dangerous assumption. There are alternatives like municipal bonds, Treasury inflation-protected securities, and diversified cash strategies. But none offer the same seamless liquidity or global acceptance as Treasury bills, and all come with their own frictions. We often think financial crises happen all at once. But the truth is, they start in the margins. A failed auction here, a funding mismatch there, a few quiet reallocations by big players. By the time the headlines catch up, the real damage is already done. Right now, we are still in the early phase, but the symptoms are real, and the margin signals are flashing yellow. If the market begins to question the reliability of Treasury bill liquidity itself, not just pricing, we could move from unusual conditions to outright dysfunction much faster than expected. Unlike a stock market drop, a funding market disruption affects everyone. Banks, corporations, governments, households. The ripple effects go through the balance sheet, not just the news cycle. This is not just about the Treasury market. It is about the dollar system itself. And the cracks are already forming. So do not tune out. Listen carefully. Watch the margins. And if you want more of these breakdowns when the next shockwave starts to ripple, make sure to hit subscribe. Thank you for watching and stay sharp.